My dear students, welcome back to our channel. In this video, I will be explaining the MBA 4th semester subject Financial Analytics as prescribed by JNTUH and other universities of Telangana. We will go through the important questions and answers one by one. Let's begin with a quick revision. Unit 1 first important short question is horizontal analysis, vertical analysis. Horizontal analysis compares financial data across 2 or more years. It shows how much each item, like sales, expenses, has increased or decreased over time. This helps us know the growth or decline in a company's performance. Example: if sales were 10 lakhs rupees in 2023 and 12 lakhs rupees in 2024, change is equal to 2 lakhs rupee increase 20% growth. Vertical analysis shows each item on the financial statement as a percentage of a base item. Mostly used for 1 year, it helps in understanding the structure of costs and income. Example: if total sales is equal to 10 lakhs rupees and cost of goods sold is equal to 6 lakhs rupees, COGS is equal to 6 lakhs rupees 10 lakhs rupees times 100 is equal to 60%. Easy tip to remember. Horizontal is equal to time-based comparison. Vertical is equal to percentage of total. These tools help in better decision-making by spotting trends and analyzing financial health. Next important short question is 2. Liquidity. Liquidity means how quickly a company can convert its assets into cash to pay short-term bills and expenses. It shows the company's ability to survive in the short term without borrowing or selling long-term assets. Think of liquidity like your wallet. Do you have enough money to pay for tea, rent, or travel today? 2 common liquidity ratios. 1. Current ratio is equal to current assets current liabilities. Example: assets is equal to 1,50,000 rupees, liabilities is equal to 75,000 rupees, ratio is equal to 1, good. 2. Quick ratio is equal to current assets, stock, current liabilities. Used when stock is hard to sell quickly. A higher ratio means the company is in a safe zone, while a low ratio means the company may struggle to pay its short-term dues. Easy tip to remember. Liquidity is equal to ready cash is equal to safety. Strong liquidity is equal to smooth business running. Next important short question is 3. Profitability. Profitability shows how well a company is earning profit from its sales and resources. It helps us understand if the business is actually making money after covering all costs. Think of profitability like a farmer selling crops. After spending on seeds, water, and labor, how much is he really earning? Common profitability ratios. 1. Net profit ratio is equal to net profit sales times 100. Example: net profit is equal to 1 lakh rupees, sales is equal to 5 lakhs rupees. Net profit ratio is equal to 20%. 2. Return on investment, ROI, is equal to net profit capital times 100. It shows how much return the business gets on money invested. A higher profitability ratio means the business is doing well and is efficient in making profits. Easy tip to remember. Profitability is equal to profit power. It tells how smartly a business turns sales into earnings. A profitable business is equal to happy investors and owners. Next important short question is 4. Solvency. Solvency means a company's ability to pay its long-term debts and continue running in the future. It shows how strong and stable the business is in the long run. Think of solvency like owning a house loan. Can you manage your EMIs for the next 10 to 15 years without going bankrupt? Common solvency ratio. 1. Debt to equity ratio is equal to total debt shareholders' equity. Example, debt is equal to 4 lakhs rupees, equity is equal to 2 lakhs rupees. Ratio is equal to 1 company has more debt than its own funds. A low ratio, like 1:1 or less, means good solvency, the company isn't overburdened by loans. A high ratio means risk, the company might struggle in the future. Easy tip to remember. Solvency is equal to long-term strength. It tells whether a company can stand strong for years or may fall under debt pressure. Solid solvency is equal to strong foundation. Next important short question is 5. Turnover ratio. Turnover ratio shows how efficiently a company uses its assets to generate sales or revenue. It tells us how fast the business is turning over its stock, cash, or other assets into income. Think of turnover like a shopkeeper selling items. If stock is sold quickly and restocked often, the business is efficient. Common turnover ratios. 1. Inventory turnover ratio is equal to cost of goods sold average inventory. Example, COGS is equal to 5 lakhs rupees, inventory is equal to 1 lakh rupees, ratio is equal to 5 times. Stock is sold and replaced 5 times in a year. 2. Debtors turnover ratio is equal to net credit sales average debtors. Shows how fast the company collects money from customers. Higher turnover ratios mean the company is managing assets well and earning efficiently. Low ratios mean money is stuck in stock or with customers. Easy tip to remember. Turnover is equal to speed of business. Faster turnover is equal to more sales, better cash flow, stronger business. Next unit 1. Long questions. First important long question is trend analysis. Trend analysis is a technique used to study financial performance over several years. It helps to identify whether a company's sales, profits, expenses, or other financial items are increasing, decreasing, or remaining stable over time. Imagine checking your marks from class 9 to class 12. If your marks in maths are improving every year, you know you are doing well, that's a trend. How it works? In trend analysis, we select a base year and compare all future years with it. The base year value is considered 100% and other years are shown in percentage form. Formula. Trend percent is equal to current year value base year value times 100. Example. Let's say sales for a company are 2021 base year 5 lakhs rupees. 2022 6 lakhs rupees. 2023 7 lakhs 50,000 rupees. Now calculate trend percentages. 2021 is equal to 5 lakhs rupees. 5 lakhs rupees times 100 is equal to 100%. 2022 is equal to 6 lakhs rupees. 5 lakhs rupees times 100 is equal to 120%. 2023 is equal to 7 lakhs 50,000 rupees. 5 lakhs rupees times 100 is equal to 150%. This means sales grew by 20% in 2022 and 50% in 2023 compared to 2021. Why it's useful? Detects growth or decline in key areas like profit, expenses, assets, etc. Helps in forecasting future trends and planning business strategy. Useful for investors, management, and analysts to understand company direction. Easy tip to remember. Trend analysis is equal to time travel in numbers. It shows whether a company is going uphill or downhill financially over the years. Helpful for planning future growth. Not useful for just 1 year, needs 3+ years to see trends. So, in short, trend analysis is like checking the company's report card across many years. Next important long question is 2. Valuation of ratios. Valuation of ratios means analyzing and interpreting different financial ratios to understand the true value and health of a business. Just calculating a ratio is not enough. We must evaluate what it means, compare it with past years, competitors, or industry standards. Think of it like a medical report. Knowing your blood pressure number is not enough unless a doctor tells you if it's normal or risky. Common ratios and how to value them. 1. Current ratio. Formula: current assets, current liabilities. Valuation: a ratio of 2:1 is usually good. If it's too high, money may be lying idle. Too low means the company may struggle to pay short-term bills. 2. Net profit ratio. Formula: net profit sales times 100. Valuation: a higher percentage shows better profitability. A drop over years can signal poor cost control. 3. Debt to equity ratio. Formula: total debt shareholders' equity. Valuation: a lower ratio is safer. A high ratio, like 3:1, means the company is taking more loans than it should. Example: let's say a company has current ratio is equal to 1.21. Net profit ratio is equal to 10%. Debt to equity is equal to 2.51. Valuation: current ratio is low, possible liquidity problem. Net profit is average, may need to improve margins. Debt to equity is high, risky financial position. Why it's important? Helps in making investment decisions. Shows company strength and weaknesses. Assists management in improving performance. Easy tip to remember. Valuation of ratios is equal to reading between the numbers. It's not just about what the ratio is, but what the ratio means for business performance. So, to truly understand a company, always calculate plus compare plus interpret the ratios. Next important long question is 3. Classification of cash flow. Cash flow means the movement of actual cash in and out of a business. It shows how much money a company is really earning and spending, not just on paper, but in hand. Cash flow is classified into 3 main activities. 1. Operating activities, daily business work. These are cash flows from the core business operations, buying, selling, paying salaries, etc. Example: cash received from customers. Cash paid to suppliers or for electricity bills. Positive cash flow from operating activities means the company is healthy and running smoothly. 2. Investing activities, buying and selling assets. These involve cash used for long-term assets like land, machines, or investments. Example: buying a new building. Selling old machinery. Investing in shares of other companies. Investing cash flow is usually negative for growing companies because they are buying assets. 3. Financing activities, raising or repaying funds. These include cash movements related to loans, shares, and dividends. Example: taking a bank loan. Repaying a loan. Issuing shares. Paying dividends to shareholders. Positive financing cash flow means the company is raising funds. Negative means it's repaying or distributing profits. Quick example summary. Activity: cash in plus cash out. Operating: from customers to suppliers, salaries. Investing sell land machine buy land machine. Financing bank loan, share issue loan repayment, dividends. Easy tip to remember. OIF is equal to operating, investing, financing. O is equal to operations. I is equal to investments. F is equal to funds, loans, shares. This classification helps understand where money comes from and where it goes, which is key for judging a company's financial health. Next important long question is 4. Investing and financing activities. When we talk about cash flow, two important parts are investing activities and financing activities. Understanding these helps us know how a company spends or raises money beyond daily business. 1. Investing activities. This is cash spent or earned from buying and selling long-term assets like buildings, machines, or investments. Example. Buying a new machine for 5 lakhs rupees cash outflow, money going out. Selling old equipment for 2 lakhs rupees cash inflow, money coming in. Usually, investing activities show a cash outflow when companies grow, but selling assets brings cash in. 2. Financing activities. This involves cash movements related to raising or repaying money for the business. It covers loans, shares, and dividends. Example. Taking a bank loan of 10 lakhs rupees cash inflow. Paying back 3 lakhs rupees of a loan cash outflow. Issuing shares to investors cash inflow. Paying dividends to shareholders cash outflow. How to compute net cash flow from investing and financing. Net cash flow is equal to cash inflows, cash outflows. If cash inflows are more, net cash flow is positive, meaning the company got more money. If outflows are more, net cash flow is negative, meaning the company spent more. Example. Investing activities. Cash spent on machinery is equal to 5 lakhs rupees outflow. Cash from selling land is equal to 3 lakhs rupees inflow. Net investing cash flow is equal to 3 lakhs rupees to 5 lakhs rupees is equal to 200,000 negative. Financing activities. Loan taken is equal to 10 lakhs rupees inflow. Loan repaid is equal to 4 lakhs rupees outflow. Dividend paid is equal to 1 lakh rupees outflow. Net financing cash flow is equal to 10 lakhs rupees, 4 lakhs rupees plus 1 lakh rupees is equal to 5 lakhs rupees positive. Easy tip to remember. Investing is equal to buying selling assets. Financing is equal to raising repaying money. Together, these show how the company manages money for growth and funding beyond everyday business operations. Next important long question is 5. Reporting and interpretation using spreadsheet. Using a spreadsheet like Microsoft Excel or Google Sheets makes it easy to report and analyze financial data, especially cash flows. It helps organize numbers clearly, do automatic calculations, and create charts for better understanding. Why use spreadsheets? Saves time by doing automatic math, adding, subtracting. Easily compare data over years. Quickly spot trends, patterns, or problems. Create visual graphs like bar charts or pie charts to show data clearly. How to report and interpret net cash flow in spreadsheet? 1. Prepare data. Make columns for cash inflows and cash outflows under each activity: operating, investing, financing. Activity cash inflows, cash outflows, net cash flow. Operating 5 lakhs, 3 lakhs 50,000 is equal to B2, C2. Investing 2 lakhs, 4 lakhs is equal to B3, C3. Financing 10 lakhs, 6 lakhs is equal to B4, C4. 2. Calculate net cash flow. In the last column, use formula to subtract outflows from inflows. The spreadsheet does this instantly. 3. Interpret the results. Positive net cash flow means more cash came in than went out. Negative net cash flow means the company spent more cash than received. Example. If the total net cash flow is positive, it means the company has enough cash to pay bills and invest in growth. If negative, it might need loans or other funding. Easy tip to remember. Spreadsheet is equal to financial calculator plus visualizer. It makes reporting fast, accurate, and easy to understand. So, always use spreadsheets for neat, clear, and quick financial analysis. It's like having a smart assistant for your money matters.